Now to the economy and the fight to slow inflation. The Federal Reserve announced a 0.75% rate hike this afternoon, 2 weeks after the worst inflation reading in more than 40 years. The Fed noted job gains have been robust in recent months and the unemployment rate remains low, but inflation continues to be elevated, something the Fed hopes to tame with this fourth rate hike of the year. Here's ABC's Derek Dennis with the details.
Following its latest two-day meeting, the Federal Reserve is raising interest rates as it looks to tame inflation.
Today, the FOMC raised its policy interest rate by 0.75 percentage point.
The increase means borrowing for everything from mortgages to car loans and credit cards will be more expensive. The average credit card balance right now is about $5,010. If you're only making the minimum payments with this new rate hike, your APR is likely to jump from about 17.25% to 18%. That means an additional $283 in interest you have to spend to pay off that balance. One positive for consumers, they will likely see slightly higher interest earned on their savings. This marks the fourth rate hike from the Fed so far this year, and there are some indications these increases are having an impact. Walmart has cut its profit outlook, saying customers are spending less and gas prices have been on the decline. The national average now stands at $4.33, down 16 cents in the past week.
The reduction in gas prices that you've seen over the last couple of weeks is providing some measure of breathing room. Not enough, but some measure of breathing room.
But consumers are still facing higher costs at the grocery store. GOP Senator Chuck Grassley has released a proposal to fix a flaw in the child tax credit, pegging it to inflation so it pays out more during stretches of rising prices.
We're trying to touch some parts of the tax code with indexing so that it reflects the 9% inflation and still will benefit middle income and low income families.
Consumer confidence has fallen in July for the third consecutive month. That, along with slowing home sales, suggests the economy has begun to weaken. Derek Dennis, ABC News, New York.
And you may be wondering how the Fed raising interest rates actually helps the economy, so we took an in-depth look at information from the financial advising group known as Smart Asset and have an answer for you tonight. First, we must understand what inflation is. According to Smart Asset, inflation is the rate of increase in the price of goods and services over time. Inflation is caused when demand over time increases more quickly than supply. One factor of this inflation was the pandemic. During COVID, families received stimulus checks and had more money to spend and were buying more products, so prices went up to control demand. There was also the supply chain shortage as well. So to try to stop prices from continuing to climb and get the economy to cool down, the Federal Reserve will raise interest rates. When interest rates rise, it becomes more costly to borrow money. This action leaves people with less money to spend, so demand goes down with the hopes that prices go down eventually.